Hi, my name is Eng Tang with Tozy Capital, and I am joined by my special guest, Parker Webb. Would you like to introduce yourself, Parker?
Hey, Parker Webb of FTW Investments here in Kansas City.
Yeah, so Parker and I have been partnering a few deals in Kansas City, and he's one of those local experts everyone hears about in a great market. And I think that's going to be the crux of this deal here. So we're going to talk today about Independence 3, a three apartment portfolio, 426 units, in Independence, Missouri, a submarket of Kansas City. So it's going to be an executive summary, and you will be also getting the full deck so you can review it at your own leisure. But we're just going to really talk through the highlights of the deal, and hopefully you will consider it and let us know if you have any further questions. So with all things real estate investing, I think it's prudent to talk about COVID-19 and its impact on real estate investing, the commercial real estate sector, multifamily sector. And to the extent that there's a lot of uncertainty, there's new bills on the table right now. Today is July 29th, and things could change August 1st. To the extent that the Fed has done a ton of actions that has direct impacts on real estate, we've seen that with the V-shaped recovery in the stock market. We've seen an injection of a ton of liquidity backstopping corporate bonds and mortgage-backed securities, and that has created asset inflation. When you print more money, the money has to go somewhere. When saving rates are zero and the borrowing rates is low, you have asset inflation. So I think that's a good counter to where I believe real estate will be. In addition, when people talk about investments, they always think having cash is great when there's uncertainty. I think having cash flow is almost as good and even better, because if you can get into an asset, which this is that has stability and positive cash flow, you're essentially mitigating a lot of your own future risks. In addition, real estate is just a great hedge against inflation. So these are reasons why while I do monitor what's happening with COVID-19, and we try to create steps to make sure that we have a safe community for our tenants, and we try to be as empathetic with everyone's situation. We do believe the long-term outlook for real estate is very strong. Long-term borrowing is very cheap, and these market fundamentals create a really great incentive to invest right now.
Absolutely. I think, one of the points they're doing is that, long-term debt in and of itself is one of the greatest hedges because we were able to borrow, 78% of the capital stack as, long-term debt on a 30-year amortization locked in at 3.3%. And that is one of the best ways that real estate hedges inflation risk.
Yeah, that would have been a lot more expensive pre-COVID. And to the extent that the rates are reflective of the risk that the agencies, the banks are presuming on the asset, I think that's a good indicator. When you go and buy an asset with high interest rates, that's creating the presumption that this is increased risk. So we're borrowing at very low rates, which indicate from a lot of institutions that this asset is a very low risk asset.
Mm-hmm.
The Independence 3, so we have Winter Place, Meadowbrook, and the Hudson. So we're going to go through some of the investment highlights, offering summary, breeze through the market and location. For those who invested with us before, Kansas City, it's a great market. And then we're going to highlight a little bit about the properties, go into briefly the numbers, and then focus a little bit on the team, because the team is a bigger team than usual for this size of asset. So I really want to highlight the investment highlights here. One of the things that was really interesting to me was the COVID pricing discount. I think everyone talks about COVID pricing discount, And really what's going into that is the fact that there's less sellers and less buyers. And logistically, it's hard to get buyers into regional markets like Kansas City. Parker, can you talk a little bit about the pricing negotiations that happened there?
Yeah, absolutely. So this property was originally put on the market at 23.5 million for this 3 property portfolio, and we had looked at it at that time and had run the numbers, and we didn't offer yet. COVID happened, and then the seller actually ended up pulling this off the market. And so the groups that were interested in it prior were groups from California and groups from New York, and they were not able to get here and look at the asset because there were no flights at the time. So they literally could not come here to tour the properties, but we could. And so once that happened, we circled up with them and said, hey, we'd love to walk through. We did our walkthrough, did the full analysis, and we're able to settle at a price right at 21 million. So we got it for over a $2 million discount over what we think it definitely would have sold if it was a normal market scenario.
Yeah, and that's a really powerful thing to have less of this institutional capital coming in to regional markets and having regional experts like Parker and his team at FTW really be boots on the ground and have these strong relationships with local sellers, local lenders, and local property management firms. So just talking a little bit about the other highlights, it's going to be high cash flow like all of our investments. That's what we're really looking for. It's on the basis of the strong occupancy rates that's already there, 97% physical occupancy. We have favorable financing, as Parker mentioned, 77% LTV on a 10-year term, 3.3%. It's a newly renovated asset. I really like that because it creates less risk for us in terms of future CapEx improvements. So really 1.9 million of CapEx has been improved on it. And then there's additional value add opportunity. Parker, can you talk a little bit about those?
Absolutely. So one of the things that we saw when we went into this was that the property is currently about, on average, each of these 3 properties is about 16% under market rents. And so when you look at that opportunity, you say, okay, well, where is that? And we compared this directly to like-kind properties with similar type units, and it's still under market. So we think there's immediately an opportunity to go in there and push those. But to do that and kind of get sort of community buy-in on those rent pushes, let's say, we're also going to be doing some additional CapEx on common areas. So we're going to improve play areas for kids. We're going to add dog parks at a couple of properties. We're going to paint one of the buildings and kind of clean up sort of the entrance and the face. We're going to paint, things like just rusted pipes and things that just, haven't been taken care of like that. We're going to clean all of that up, add trash enclosures and that sort of thing. So there's a lot of common area stuff that we're going to do that is everybody's going to be able to see, and it's going to be hugely advantageous. And then we'll be able to get those rents where we think they need to be. In addition to that, we're going to also do premium units. So as we turn units, right, we're not going in here to kick anybody out or do anything like that. But as we turn those units, we're going to take some of those units and do brand new kitchens, update bathrooms, flooring, all the lighting packages, the plumbing package, and paint. And so we're going to end up with some premium units. And in one of the properties, we'll actually have the ability to kind of add a little fenced-in backyard and a patio. And so that really help us to not only get up to the current market rents throughout the portfolio, but we're going to look to push those rents, prove out the model that you can get a higher rent on some of those units, which also helps us to sell because that value proposition can be passed along to the future buyer.
Yeah, that's great. I think just on the strength of its current cash flow, it already generates tons of value. Now, if we create these value add opportunities, and we strongly believe we can, based on the fact that the sellers have already implemented during COVID and created rent increases partially, we believe we can continue to execute on it. And we have the operational efficiency to do so. Belmont, one of the sponsors, one of our co-sponsors, will be taking over property management of these 3 assets. Parker, can you talk a little bit more about Belmont and their depth of experience?
Yeah, absolutely. So Belmont is a group that we work with quite a bit. This is our 4th project with Belmont. They are a group based out of Oklahoma City, principally a multifamily operator. They have 5,000 units across the Midwest. They're vertically integrated with Belmont Management, Belmont Construction, and Belmont Development. So Belmont Management, headquartered in Fort Smith, Arkansas, already has a regional manager here in Kansas City. and we'll be taking over all of the kind of property and management responsibilities.
Yeah, and we believe in this investment so much, we're committing at least 15% of the equity contribution, which is a really above average for these type of investments. So I'm going to breeze through some of this. In the Independence 3, it's a 426 unit, 3 property portfolio in historic Independence. The offering summary, I think we talked a little bit about the business plan already, but I just want to highlight some of these numbers. And these numbers are with conservative estimations of where rents could move up to with what we've seen it to be now. And so we have room to grow here, which is, I think you should always be conservative on modeling anything, especially during these times, to factor for increased risk and uncertainty. But we're looking at at least a 2.1x investor multiple, 23% average annual return, and 11% cash and cash. And that 11% cash and cash is going to be day one. So it's not going to be like other value add opportunities where you're waiting for the value add to be implemented, and 18 months from now, you can start collecting any cash flow. This is going to be day one cash flow because on the strength of the IO and the already high occupancies. And so for the investors, we have an 8% preferred return and an 80-20 split, which reverts to 50-50 above 20% ARR. Really, the net for the investors is a pretty strong and compelling opportunity. And we really strongly believe that it's structured in a way to incentivize us to perform and execute at a high level, because we're not going to get paid much until this place generates a lot of value. And that really aligns our incentives with the investors' incentives. Just to continue to touch on the deadlines on the funding, we're looking for a September 8th funding deadline. That's when our due diligence period ends. And we're looking to close within September. The hard, fast deadline is October 1st. But like other projects we've offered in the past, we typically see these opportunities go by pretty quickly. In fact, we already have a lot of capital already committed to this. So if you're interested, definitely reach out to us and let us know. And we're happy to have a conversation more on this and try to consider this spot early. So I'm going to breeze through the Kansas City Metro. I really like Kansas City, Silicon Prairie. I'm in Silicon Valley right now. A lot of people are moving out of these these expensive areas into lower cost of living areas. I know several people that move into Kansas City directly. They have great, affordability, a really strong employment base that's pretty diverse, and favorable business environment. Of course, Kansas City Chiefs just won against SF. I'm not sure that's a good thing. It depends on what fan base you're on. Kansas City, there's a lot of good things to like about Kansas City. I'm going to breeze through some of this. I do want to talk about Independence a little bit because that's where these properties are located. It is a submarket of Kansas City. It's really 15 to 20 minute drive from downtown Kansas City. And there's a lot of economic development happening with Independence Works 2025 designed to align with KC Rising, another Kansas City regional plan for prosperity. So check that out. I think it's really cool to see a lot of investments into this market. It's going to generate upward pressure on assets and rents as these things develop.
Yeah, and I'll say as well, I think a lot of this highlighting that kind of the Independence Square has been completely revitalized. There's been sort of a local kind of passion investor here who has taken it upon himself to invest heavily in the Independence Square, which is downtown Independence. And that has really turned around the restaurants there, the offices there, et cetera, and more money has just been continuing to go in there. All of these properties basically make a triangle around the Independence Square. And that's kind of really the central hub of kind of bars, restaurants, and all that good stuff. So it's still doing well right now. And I was just there having lunch the other day, and it was pretty busy. So just want to point that out, that I think having that good kind of infrastructure right there in Independence Square is very helpful for us as well.
Yeah, it's a great area. Yeah, Parker, you're probably much more familiar with the area. Can you talk a little bit about sort of the general locations and its highlights?
Yeah, absolutely. So I actually grew up in this area. My family owned grocery stores throughout throughout Independence, and what this is so we're about 10, 15 minutes east of downtown. A lot of the population that lives in these properties is going to work in Independence, or they're going to work in downtown Kansas City. It's very easily accessible with 435 and I-70 nearby. This Independence is largely, I would say, kind of a blue collar or working community with incomes that would support that. And it's Independence is as well. One thing to know: the county government, Jackson County, has 2 seats. It's actually a 2 seats county, and so Kansas City is part of the county government, and then Independence is the other county government. And so a lot of folks who live in and around Independence are also working for the school district, or they're working for the county government that's headquartered there.
Yeah, I think that creates a lot of strong job base with federal governments generally don't contract even during recessions. So something that
Yep.
you probably see in DC has been one of the biggest boom cities for continuously for the last 20 years, even during the last 2 downturns. So. I really like Independence. I think it offers a lot of value as well. I think that's where we as investors we want to make sure we get high cash flow, high returns. We're going to be investors in this deal ourselves. So I think that's ultimately what we're prioritizing. We want to build more wealth, build more cash flow for ourselves, and we want to invite our investors and our partners to participate in that because we fundamentally believe in the strength of these assets in this type of investment. So I want to breeze through some of the properties. This high occupancy house property management, newly renovated. It's a really good unit mix as well. I think that generates a lot of value from a multiple tenant base, and I think that's going to allow us to tap into many different types of tenants that needs a studio, 1 bedroom, or even 2 or 3 bedroom. So the average vintage year built is 1972. But remember, there has been a significant CapEx improvement over the last year. So a lot of this has been renovated already. And current occupancy, physical occupancy is 97.8%, even during this last 3 months of COVID. So this is the unit mix. You can view that yourself. Unit Place is it's a really interesting asset, and it's similar to the other ones in terms of how its diversity of unit mix and how much additional rent you could have. So in addition, one of the things that we haven't mentioned potentially is the RUBs we're going to be implementing throughout. Can you speak a little bit about that and how that generates additional revenue?
Absolutely. So these properties all have central water and sewer, and so the seller has already implemented on new leases as they roll have implemented a RUBS cost. And what that means is basically they're now, instead of just eating that cost of the water and sewer, they're now billing the tenant for water and sewer. So that's been implemented through about a quarter of the property, and we will continue to implement that all the way throughout. So this additional revenue stream we'll be able to add in.
That's great. And that's going to be across all 3 properties. So I'm going to breeze through these. I don't want to spend too much time. This is really meant to be an executive summary and highlighting sort of why we like this property, why we like these properties in general. And as we touched base previously, Belmont Management Company is going to be managing it. We're additionally potentially looking to retaining some of the existing personnel, right, Parker?
Correct. Yep.
Yeah, so
we were just having a today. There are some people that would like to stay on board, and we'd like to have them, and we think kind of carrying over that institutional knowledge is really helpful as well.
Yeah, it's going to create very much a seamless transition, but allow us to still have that expertise from Belmont, who's going to be a co-sponsor on the deal as well. So just some of the offering highlights. It's a 506B, and which means we're going to allow some sophisticated investors, uncredited investors. It's 8% preferred return, 80-20 split, 50-50 above 20% AAR. Net for the investors essentially would be 2.1x multiple on your investment, so you double your money in 5 years. Average annual return is 23%. So I'm going to breeze through some of this since you've seen this and you can review it on your own terms. I also like to think about the sensitivity analysis as well. I think right now we have a lot of room for buffer. That's going to be really shown because of this high DSCR. Now, usually banks and agencies like to underwrite for 1.4, 1.5 DSCR at the, some even as low as 1.25 or 1.3.
The agencies right now are anywhere between 1.3 and 1.6. So.
Yeah. And so what DSCR means is debt service coverage ratio. It's really, if you have a 1, that means you're just creating enough cash flow to pay your debt, and that's it. And in the Bay Area, it's probably negative. When you have a 2, that means you're doubling it, and you have a lot of room for buffer, which really is going to be a healthy way to operate businesses nowadays, because you never know what's going to happen. Potentially have more economic uncertainty, but it's going to allow us to essentially pay the debt on time and allow us to navigate through any uncertain time periods. You can do some of this. Some of this stuff for you guys who've invested with me, I've talked a lot about the tax advantages of real estate. This is something that we don't really share too much, but I want to highlight the fact that Kansas City is a low land value place, coupled with the fact that you have high leverage. It's a recipe for amazingly high bonus depreciation. And the way that works is the depreciation happens on non-land value. And if you're buying in California, the land value could be 50 to 60, 70%. In Kansas City, it could be as low as 5%. And so if you can depreciate the entire purchase price, you can take more of the tax advantage now. That depreciation, if you're not a real estate professional, if you're just taking it for your passive income, allows you to shelter all the income, all the cash flow from this property for at least the first 4 to 5 years. And if we plan it correctly, likely you're deferring taxes for the future.
Absolutely.
So the ownership structure, I wanted to highlight that it's going to be a partnership with Tozy Capital, FTW Investments, Belmont Development, and Sixton Lee. We all have really strong experience, and we've worked together in previous deals. So it allows us to both lend our expertise to where needed on a portfolio size is large. And for the investors, you're going to be really just investing in Independence 3 LLC, that's TBD name, allows you to be a passive investor and not have any liability that the management will take care of. So the team is Tozy Capital, FTW, and Belmont. And I want to highlight that all of us have a strong track record, but specifically Belmont with their depth of experience in this specific asset class. And I want to highlight that too, because not a lot of syndicators, investors, investment firms have a lot of experience in this type of asset in these tertiary, secondary markets. And so you need to have that niche experience, and we're going to be borrowing a lot of that experience from Belmont. And they've had a proven record of successful exits as well. So that is Independence 3. We look forward to partnering you and on this deal, and hopefully many more to come. Let us know if you're interested, and feel free to ask us any questions with it. But keep in mind the deadline of early September, likely when it will probably run out of funding. Again, my name is Anh Tang from Tozy Capital, and I'm joined by my guest Parker Webb from FTW Investments.
Thanks, everybody.